Imagine this. You wake up, you roll over, you check your phone, and before you've even had a sip of coffee, your portfolio is already down 9%. The headlines on your screen are bland. They say things like, markets fall amid uncertainty. There's no drama, no sense of panic, no emergency language. And yet, something feels deeply wrong. Something feels different. Because here's the uncomfortable truth about how markets really break. Market crashes don't begin with screaming and fear. They begin when risk feels completely invisible. Every single major crash in history starts this way. Think about it. Go back to 1929. Investors weren't terrified. They were convinced that stocks had reached a new permanent plateau. They believed the game had changed for good.
Fast forward to the late 1990s, the dot-com bubble. The old rules were out. Tangible profits were replaced by a new, exciting metric: clicks, eyeballs, potential. And it felt revolutionary. Then, in the mid-2000s, an entire nation was built on a single, unshakable belief. Housing prices, on a national level, simply could not fall. It was considered a law of physics. And in every one of these cases, the people putting their money on the line didn't feel reckless. They didn't feel like they were gambling. They felt smart. They felt like they were ahead of the curve. Why? Because for a long, long time, prices just kept going up. Every day, the market told them they were right. Every month, their statements confirmed their genius.
That's the seductive nature of a bubble. It doesn't feel like a bubble from the inside. It feels like the new reality. Crashes, you see, don't come from sudden, shocking surprises. They grow out of something much quieter. They come from confidence, stacking on top of confidence, layer after layer, until the foundation becomes brittle. So right before a major crash, you don't hear panic in the commentary. You hear calm, rational explanations for why the high prices make perfect sense. You hear the same refrains over and over. Oh, this is healthy. This is just a little correction, a buying opportunity. And the most dangerous phrase in finance: this time is different. That mindset, that calm, collected, absolute certainty that the old rules no longer apply, that is always, always the starting point of the disaster. It's a paradox, really. If markets were truly afraid, if everyone was on edge and looking for the exits, they wouldn't actually be all that dangerous. A cautious market protects itself. It's the fearless market, the one that has forgotten what risk even looks like, that is poised on the edge of a cliff. So if crashes don't start with fear, if they start with this profound, pervasive sense of calm, the real question becomes, what patterns show up every single time, long before the prices actually collapse?
Valuation. Why? History gives us a pattern. Different centuries, different assets, but always the same mistakes. Let's go all the way back to 1637, to the Dutch Tulip Mania. At its absolute peak, a single rare tulip bulb was trading for more money than a skilled worker could earn in a decade. Think about that. People weren't buying flowers. They were buying pure, uncut confidence. And that confidence always shows up in two forms that are eerily familiar today. The first warning sign is when overconfidence completely replaces valuation. Every financial bubble whispers the same lie to investors. The price itself is proof. It argues that if something is expensive, it must be valuable. We saw it in the late 1990s when companies with no revenue, no earnings, nothing but a .com in their name went public for millions. And we saw it again in 2021 when other profitless companies rocketed to tens of billions in.
Because belief had replaced measurement, the story became more important than the numbers. In 2021 alone, retail investors, everyday people, made up over 20% of all U.S. stock trading. That's the highest level in history. Markets weren't rising because the underlying businesses were getting stronger. They were rising because participation exploded. And being part of a growing crowd feels incredibly safe, right up until the moment it doesn't. The second warning sign is leverage, and it almost always builds quietly in the background. Every crash needs fuel. That fuel is debt. In 1929, the fuel was margin loans, people borrowing money to buy stocks. In 2008, it was household mortgages, repackaged and sold as safe investments. Today,
The borrowing is happening at the government and corporate level on a scale we've never seen. Right now, U.S. federal debt exceeds $34 trillion. U.S. household debt is above a record $17 trillion. And corporations that borrowed cheaply for years are now being forced to refinance their old debt at far, far higher rates. Here's the critical point. Debt itself doesn't kill markets. The refinancing of that debt at punishingly high rates does. And after the fastest series of interest rate hikes in over 40 years, that immense pressure still hasn't fully surfaced. It's a slow-motion shockwave, still traveling through the system. So we have the confidence, a blind belief that the price is always right. And we have the leverage, the fuel waiting for a spark. But there's a third ingredient needed to turn a bubble into a full-blown catastrophe. It's a system everyone trusts, but no one has truly stress-tested.
Every generation invents a tool designed to reduce risk, and every generation eventually learns it only works under specific conditions. In 1987, it was portfolio insurance. In 2008, mortgage-backed securities. In the 2020s, it's something quieter, something that feels safer than anything that came before it: passive investing. Today, over half of all U.S. stock market assets are held in passive funds and ETFs. This structure is incredibly efficient as long as the markets are calm. But what happens when stress hits? Suddenly, the efficiency becomes the danger. Everyone owns the same basket of stocks. When fear takes over, everyone tries to exit through the same single door. And liquidity, the ability to sell without crashing the price, vanishes faster than anyone expects. We saw a preview of this in March 2020. The S&P 500 fell 34.
Only sellers do. So what happens when that kind of market stress meets leverage at the exact moment that global policy is changing direction? That's when crashes stop being theoretical. So, are we headed for one now? Here's the honest answer. No one knows when a crash will happen. Anyone who gives you a date is selling something. But history tells us something much more useful. Crashes don't happen at the extremes of a market cycle. They happen during the transitions between them. And right now, we are in the middle of a massive transition. The era of cheap money is gone. For the first time in over a decade, valuations matter again. Cash flow matters again. This isn't the end of the world or the end of markets. It's simply a rule change. And rule changes always expose the fragile players. So what do smart investors do? They don't panic. They don't try to guess dates. They do three things consistently. First, they reduce their fragility.
This means no single all-or-nothing bet. No single story they believe in so much that they ignore all other evidence. They diversify across assets and ideas. Second, they respect liquidity. In a world of uncertainty, cash isn't trash. It's not a dead asset. It's optionality. It's the power to act when everyone else is being forced to sell. And third, they stay invested, but they become highly selective. They know that panicking and selling everything is a mistake, because the best days in the market often happen right after the worst ones. Missing them is devastating to long-term returns. Ultimately, market crashes punish leverage. They punish the people who are overconfident and overexposed, but they reward preparation. Every crash feels obvious in hindsight. And when it finally arrives, the same question is always asked: why didn't anyone warn us? But the warnings are never hidden. They're just boring. They're structural details and quiet shifts in the rules of the game. They're boring, right up until the moment they aren't, because history is already rhyming.